Stock market, bond market, and real estate market to crash, and economic collapse. So Jamie Dimon warns swift sanctions may bring unintended consequences which can be circumvented. And if Russian currency reserves aren't really money, the world is in for a shock. Now, I've done a video, my last video, with Zoltan talking about that. And yeah, what this may mean. And it could also be what Jamie Dimon is talking about, unintended consequences. And the great Henry Hazlitt talked about unforeseen consequences that we just don't, or, economists and that these days don't talk about. And this is big news. India is exploring ways to set up a rupee payment mechanism for trade with Russia to soften the blow on New Delhi. And breaking, Russia's state-owned Sberbank is to replace Visa and MasterCard with a new MIR card system in partnership with China's UnionPay. And why is that? Well, Visa and MasterCard are suspending operations in Russia, and local banks seem to be scurrying to partner with China's UnionPay to begin issuing new cards. But what on earth is UnionPay? Spoiler alert, they're bigger than you think. And George Gemmon makes a really good point here. One thing I find interesting is Russia has own Visa payment system, so Visa MasterCard suspending operations mostly impacts Russians not in Russia. And Luke here retweets Richard Wallen, where he said, Powell emphasized that the US ties to Russia through trade and investment are not significant and are unlikely to cause problems on their own. Well, Luke says the Fed is about to relearn the lesson that leverage is fungible. Bernanke made the same mistake when he said subprime is contained. Buckle up. And even Bond King or Bond expert, I guess Jeff Gunlock is the Bond King, the real Bond King. What's Bill Gross? I don't know. Well, maybe the Bond Prince? I don't know. But he tweeted, Stagflation is here, but coming soon will be recessionary inflation. Seemingly contradictory, but unique to the current situation. I agree 100%. And this is a chart of fertilizer. Very much hyperinflationary. And Russia is the top exporter of fertilizers, accounting for more than 13% of market share. More than double the US in terms of share and also revenue. And on the import side, the US and EU are net importers, thus heavily dependent on Russia's production. So from Jim Bianco, the national average of gasoline prices is up 27 cents the last 3 days, so Wednesday to Friday, so that's last week. The biggest 3-day rise in history. I repeat, the biggest 3-day rise in history. And considering that crude oil prices were up 26% last week, this rise is probably not over. If these gains hold for the month, year-on-year March CPI, or CPI, will be 10%. Wow. So if the government numbers are going to be 10%, what are shadow stats? What are the real numbers going to be? And coming in from Reuters, China's agricultural minister says winter wheat condition could be the worst in history. And I shared this chart in a previous video. In fact, my last video. This is a chart of wheat. That looks hyperinflationary to me. And I also shared this tweet in my last video from Jessica Nutt. The global exports share between Ukraine, Belarus, and Russia. We got the two types of fertilizers. 50%. 50% of global exports for fertilizer. Wheat 25, barley 24, corn 13. She says the world is about to become very hungry. This is a huge, huge problem. We're going to see food shortages. We're going to see food skyrocket. We're going to see energy shortages. We're going to see energy skyrocket. This could be the worst stagflation we've ever seen. This is going to crash the economy. At the same time, we see inflation, CPI, absolutely skyrocket. This is we could reach peak levels on the misery index. And oil futures soar to highest since July 2008, with Brent hitting $139 per barrel and US crude hits $130. And Lawrence Lepard, I think, sums it up. And this has been my argument for some time now. But where we are right now, and if we do see, oil continuing to rise, then I think we're going to see a hyperinflationary depression where all levered assets fall in value and everything you need to live hyperinflates. Think the 1970s on steroids. What you own plummets, what you need to live soars. He says assets plummet due to a scramble to sell and de-lever. Goods hyperinflate due to supply shortages and excess money or currency chasing too few goods. That's pretty much sums up my position. And here's the front cover of Barron's, ready for $150 oil. Well, we're already at $130 as a date of this recording, which is Monday the 7th of March. I'm hearing around the West that they want to stop Russian oil and gas because that's funding the war. Well, if that happens, if they do that, we're looking at $200 a barrel oil plus, maybe even more. And that's going to destroy the global economy. There are so many consequences coming if that's the case. Now, I've shared this chart before, and I think Art Berman talked about this. And if you have a look at oil and compare it to the US CPI, it has a wonderful correlation there. So if we do see, or even if we don't see 150, even if we see 130, what it is today, we're going to see very high CPI coming no matter what happens from here on. If we get to $150 a barrel, where do you think CPI is going to go? If we get over 200, I can't even. Yeah, this isn't good. Here's just another chart. I've shared this one before as well. Same thing. Crude oil prices and CPI. So what's going to happen? CPI rises. Then it goes back to central banks. What do central banks do then? Because this is going to have an economic impact. So, the whole stagflation argument is just, I don't know how anyone can argue against that now. This is going to be a massive headwind on economic growth. At the same time, we're going to have high CPI, and maybe companies do start laying off. Maybe we see the unemployment rising again. I thought this was an interesting article from the Daily Telegraph. Era of constant electricity at home is ending, says Power Chief. And another article in the Telegraph, different newspaper. National Grid scheme to ration households' power use at peak times. I'm hearing throughout Europe that gas cans, diesel cans, whatever you want to call them, petrol cans, have run out. People have been rationing, or people have been hoarding all these petrol cans, so you can't even get them. Europe's going to go dark if they stop gas and oil from Russia. Or Europe's going dark, and we will see these energy rations happening. And think of the impact that's going to have on business. I mean, obviously on households, but think of business and then that flow-on effect into employment, or should I say unemployment. So back in February, JP Morgan expected 9 straight Fed hike rates. Did I just say that? Fed rate hikes. Do we think that's going to happen? I mean, I heard Powell say that, he'll be a Volcker. He'll do what's needed. This whole situation in Russia and Ukraine has changed a lot of things in terms of interest rates. I think central banks will be less inclined to raise as high as they were, even though I think CPI is going much, much higher. Very interesting times ahead. If central banks raise into this inflationary this stagflationary time, it's going to be very interesting. Oh, and hear from Zoltan again. Back in February, he basically said we need a Volcker moment. We need a Volcker moment to jump on inflation. Well, as I said, I believe that CPI is going to get much, much worse from here. So New Zealand have been raising rates, and New Zealand Central Bank. I found this chart interesting that from November to February that the market is expecting the New Zealand Central Bank to raise even more than they did back in November. And here in Australia, so the CBA, Australia's largest bank, the Commonwealth Bank of Australia, not to be confused with the central bank, the Reserve Bank of Australia. They're expecting that the cash rate from the RBA will be 1.25, where the market is predicting over 2%. So CBA has a much lower forecast than what the implied market pricing, the market, is predicting. So what does this mean for households? Well, when we have a look at the distribution of debt to income ratios, apparently APRA says that 6 is dire. If you've got a debt to income of 6 or more, you're in trouble. And we can see from this chart the 6 to 8. So when we look at investors, we're looking at about 33% of investors have a DTI above 6. We look at owner occupiers, we're looking at about 23%, something like that. That's a large number of both owner occupiers and investors with debt to income ratios above 6 times. So if we see interest rates rising, this is going to have big problems, big consequences. And I can speak from our business. We, over the last 18 months, have seen fixed rate loans skyrocket. In fact, most customers have been taking out fixed rate loans. Now, in Australia, we have 1, 2, 3, 4, and 5-year fixed rates. We don't have the 30-year fixed rates like in the US. A couple of banks have 10-year fixed rates, but that's as long as you can get. The most common fixed rate in Australia is a 3-year fixed rate. And, those 3-year fixed rates, 2-year fixed rates, 4-year fixed rates, they're probably the 3 most common. Well, they're going to be starting to roll off soon. In fact, according to the Commonwealth Bank, the majority of these fixed rate loans will be rolling off in June and December next year. So come 2023, all these people that fixed at 1.89, 1.99, 1.79 will be rolling off to whatever the variable rate is at the time, or they can look at refixing at that time. And we know fixed rates have now moved from below 2% to now pushing 4%. And variable rates, well, if the RBA do raise rates over the next 18 months, then a lot of these people that took out fixed rates are going to have much, much higher loan repayments very soon. So you might want to pause this video and just have a good look at this chart. I found it quite interesting and just wanted to share it with you. And I guess you can compare throughout the last 30 years and then ask yourself, where can the RBA raise rates to? And if you have a look down the bottom, can they raise to 2, 2.5 or 3%? You can then have a look at what the repayments as a percentage of income will be and whether that's sustainable. So you can see it at 2%, down to 3%. You're looking at 57 to 71% repayments as a percent of income. We're at the moment, at 0.1%, we're at around 30%, And that's with mortgage stress, which is measured on a cash flow basis, cash flow in, cash flow out, is at around 41%. So people are basically insolvent. 41% of households with a mortgage are insolvent. So we've had tremendous growth in real estate in the last 18 months, right across the West, not just in Australia, but are we now seeing Sydney house prices in particular now rolling over? Well, time will tell. So a lot of Aussies don't believe we can ever have a property market crash like the rest of the world basically had in 2008. Well, we have had a couple of big real estate crashes, one in the 1930s, and we had a big one in the 1890s. And I think John Adams has done some work on this. He's written some pieces and whatnot about the 1890s depression in particular. And he actually likens that to similar to what we've got right now. And this chart from Canada, pretty much the same as Australia as well. So house prices used to track disposable income, but then in the late 90s, 2000s, that really changed, and then we really became financialized, and banks just levered up. We saw tremendous credit growth for house prices, while at the same time interest rates were on a downward trajectory, which increases people's borrowing capacity. And in the US, I've got this chart from Danielle DiMartino Booth, Fed mortgage-backed security holdings, and S&P CoreLogic Case-Shiller National Home Price Index. Yeah, pretty. Yeah, and Daniela and many people have been calling for the Fed to stop buying MBS, and in fact selling MBS holdings, that there's no need to do that. And all it is pushing up house prices. And pretty much we had a similar thing here in Australia as well. So I've shared this chart before, and well, every time the liquidity index goes down, what happens to the S&P 500? She goes down. What's happening right now? I'd be very, very careful. Being highly levered in any market, the stock market, bond market, or the real estate market, I think there's a lot of risk across all markets right now. And we're seeing margin debt roll over. So all of this, the liquidity side of things in financial markets, yeah, central banks do taper, if they do raise rates. If they did quantitative tightening, wow. I think with the huge stagflation we're about to face because of the Russia-Ukraine crisis and the sanctions and everything else, we're in for some very, very difficult times. So how do we play it? Well, I think you need to take risk off. I think if you are highly levered, I think you really need to have a think about that. If you've got profits, maybe it's time to take some profits off the table. Maybe it's time to start just shoring up your portfolio, making some more conservative. Think about capital preservation, protecting your capital rather than, increasing capital, especially if you've had tremendous gains over the last 18 months, 2 years or so. So personally, I don't think the answer is cryptos. I think as time goes on, we're going to see more and more regulation, more laws, probably using anti-terrorism, anti-money laundering type laws, all of that sort of thing to really crack down on this. Governments want more and more control. They are going to want us all to have their central bank digital currency, hence why I'm more about analog wealth, real assets outside the banking system. I think Russia really gave an example of what we should be doing, reducing US Treasury holdings. I think bonds are disgusting as an investment at the moment. And, well, they've increased their gold holdings. And I think that's something retail investors should be following as well. So I shared Jared's tweet in a couple of videos, several videos back, maybe a couple of weeks ago. The combination of gold miners, silver, and silver miners make up about 30% of my portfolio. I have a hunch that what's coming next will make it feel like it's not enough. And I tend to agree. So how do I think we should be preparing for this? And I also shared this tweet in my last video from Peter. Russian precious metals production, palladium 40%, silver 12.5%, gold 10%, and platinum 10%. Tell me you don't want to own those metals. So I think Gold Telegraph sums this up well. Worried about currency debasement? Buy gold. Worried about energy shortage? Buy oil, gas, and uranium. Although I would add in coal in that one. And you guys know about my coal investments over the last 18 months or so. And if you haven't had a look at a coal chart recently, I suspect you should go have a look at that. Worried about a food crisis? Buy fertilizer. Want to participate in green transition? Buy copper, lithium, nickel, silver, and rare metals. Welcome to my world. And this is how I've been accumulating my portfolio over the last 18 months, 2 years, actually probably longer than that. So what do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.